Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time.
All opinions expressed by the host and the podcast guests are solely their own opinions and do not reflect the opinion of Devonshire Partners, LLC, or any affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The hosts and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is Andy Kurita, the portfolio manager at Kettle Hill Capital Management. Andy has a track record in long-short investing in small-cap U.S. equities that goes back to the early 2000s. We haven't had many managers who actively short on the podcast, and I was curious to hear from Andy about how Kettle Hill is differentiated versus other hedge funds, what he thinks about the small-cap investing landscape today, the difference between a stock that fits in the long book versus in the short book, what it has been like to be a short investor in recent years, and how he thinks about concentration and risk management. And without any further ado, here's my conversation with Andy Kurita of Kettle Hill Capital Management.
Andy, you have a track record that goes all the way back to 2003. I'd love to start this interview off with an overview of the public equity strategies you manage today at Kettle Hill.
Yeah, so we've got two strategies. We've got the core product, which is a low net exposure, conservative, long short equity strategy focused on small mid cap companies, and then we've got a long only strategy that we started 5 years ago, and also focused on small mid cap. It's basically an extension of our long book in the hedge fund.
And we'll talk a little more about the long only strategy and why you started that. But taking a step back from the nuances, I'm just curious about if these two strategies, what are the key principles that are informing you, informing the execution of these strategies from a philosophical perspective?
Yeah, my general philosophy has largely been the same since I started the fund in 2003. So I always thought that hedge funds should, and active managers in general, should be addressing an inefficient market. I just don't think there's any sense to be doing this otherwise. And then second, one of the core principles was that the AUM needs to be appropriate to the size of it, to the opportunity. So liquidity is incredibly important, and we want to make sure that we're not impairing the ability of the strategy to perform. Um, the other general view that I have is that, if you're looking at, the track record of a fund, the way to generate long-term alpha is by making a very long series, thousands of high expected return bets. So I think about investing very much like a poker player would think about it. So, back to my point about an inefficient market, that's kind of like game selection in poker. So if you're the 10th best poker player in the world and you're playing against 1 through 9, you're going to lose a lot of money. So pick a game that you think you're likely to win. And then in terms of thinking about high expected return bets, that's really targeting situations with an asymmetric risk reward. So when I started out, I started thinking about let's say I'm only right half the time, and I want to have, situations when I only lose 10%, but when I'm right, I can make 50% or more, and that would be, a 20% expected return every time I make a bet. So, the thought is that, whether I'm making a bet on an individual security or a certain sector or the overall, net exposure of the fund, um, the key is to avoid the risk of ruin, to not have one bet undo all your hard work and kill your track record. So I think about things in terms of probability, and that boils down into our process. Just the way we source ideas. It's based on back testing as opposed to purely theory. And I don't get too fussed when an investment doesn't go right, because I'm already assuming I'm going to be wrong half the time. So, um, and to that point, that's why liquidity and having the right size AUM is really important, because you can really impair your downside, and also impair your upside if you don't have the flexibility to trade around the position. So that's really key to me. And hopefully my long-term track record will represent a series of high expected return bets without having one bet kill the fund. And then the other core philosophy I had when I started was that my sweet spot for the duration of these bets is about 12 to 18 months. So I feel like it is short enough where you can identify clues that will be leaders of um, forward performance and stock price movement. Not and it's far out enough where it's not being chopped up and it isn't already been discovered by the market, just in terms of the efficiency of the market. And there are many players that aren't willing to wait that long to see if a bet pays off or not. And then, conversely, it's not so far off in the distant future that you can't really predict. The one thing, that I believe is that change is constant. And, with whether it's with, individual stocks, whether it's how the market trades in general in response to certain data, it's constantly changing. The players are constantly changing. And, in the 21 years that I've run the fund, we've had to, respond and adjust to change. So that's what we're investing in. We're trying to identify change and then quantify it.
And when I think about making a bunch of small bets and the way you're talking about your time frame, turnover is something that comes to mind. And I think whatever, there's certain people in the world who think high turnover is, a sign of lack of conviction, or some, there's sometimes people have a derogatory sense of high turnover strategies. I'm just curious how you've thought about turnover, and is there a right number for that, or is it really just based on you're managing the portfolio and you're not focused so much on an external, external metric like that?
Yeah, I believe that the risk reward of a position is constantly changing. So, the price is always changing, and that affects the risk reward. So, why would you have a larger position size on when the price has just gone up a bunch, and all of a sudden the risk reward is no longer as good as it was when the price was lower? And then you're constantly flipping over new cards, right? So that Peter Lynch analogy of playing seven card stud, there's a lot of poker analogy in this, right? In terms of risk of ruin and expected return bets. But you're constantly getting new data. So I feel as every card that gets turned over, it's a new data point, and we're dealing with incomplete information. So if you're not responding to that, then you've kind of got your head in the sand, in my opinion. So, and the way we structure these positions is like, yeah, we've got, part of the bet on, and, is like a 12 to 18 month type bet. We might have part of that bet that might extend for years. And there are stocks that we've had in the portfolio for years where we've had a core position there for years. But then there's a certain component of it that is more tactical and responsive to price movements, or changes in data, or changes in positioning. And I feel that we generate a lot of alpha from that. And if you're ignoring that, you're just leaving it on the table. So there's a certain portion of it that's based on the long-term thesis, and then there's a certain portion of it that's based on shorter term bets to dynamically increase or decrease the exposure. So in my mind, if you're not turning it over, you're not really paying attention. My background, I mean, I was a generalist analyst, but I was also industry specific at one point in my career. And when I was industry specific, I could see that there were specific data points driving the movement of every stock in my universe that I was covering on a daily basis. So if you don't understand the movements, what's driving the narrative on every wiggle of a chart, you're missing something. So I think paranoia is a feature, not a bug. And I'm a firm believer that you know part of the way to generate alpha is to it's not just stock selection, right? There's a certain element of point to point from now until 2 years later. I can pick the stocks that will outperform the market. Like that's really nice, but along the way, stocks don't go up and down in a straight line, and then the thesis might change. So if you're not intellectually honest and open to the possibility that something might change for the worse, there may be a new competitor, maybe one of the bets that they've made, the company has gone awry. You never know exactly what's going to happen. Maybe the macro environment shifts. So I try to be responsive, and I think that helps reduce the volatility of the fund. It improves our performance and hopefully preserves capital because I view it from a percentage basis. There's a certain percent of these we're going to get wrong, and part of keeping that minimizing the downside is by recognizing when that happens and then cutting the position. So sorry, that's a very long-winded
Mhm.
answer to a very simple question.
No, I
So
appreciate that.
feel free to cut me off
Yeah.
if I'm talking too much.
No, no, no. I appreciate that. And you mentioned back testing, which is not something we've heard a whole lot on this podcast. So how does that play and function within your process?
Yeah, yeah. So I think that when we're you know a lot of value investors start from the premise that cheap is good, and that is and there are some simpler value strategies that were conducted dozens of years ago that they turned into quantitative products and amassed a ton of assets. But realistically, we back tested these ourselves. When you look, whether you're looking at low PE or low EV to sales or this or that, and statistically, it didn't really add to any outperformance in the time frame that we were interested in investing in. So we wanted to back test and see, just as a starting point, because you've only got so many hours in the day, right? So why chase down all these leads that might be no, you might as well just throw a dart and start looking at a stock if it's not going to be useful. So I feel like a lot of value firms do that, but the thing is you're evaluating static multiples, and you're evaluating either historic or public estimates to come to that conclusion that something is therefore cheap, and then worthy of investment. And you know, so we isolated a certain number of things that we feel are statistically useful starting points, and so that's the reason for back testing. And then what we also do is we evaluate our own performance. So that's the benefit of having so many years of operation. You can look back and see, how do we do with stocks of a certain market cap, right? And we came to the conclusion that micro caps, anything under like a billion, we were pretty bad at. And I don't know if it was because of, just the worst management teams, being able to execute on a plan, or if it was the cost of exit, right? So if when you realize you're wrong, how many days does it take you to exit the position? And therefore, we found that our upside downside ratio was roughly even. Whereas, we found that, from sort of small to mid cap stocks, our upside downside ratio was, 2 to 1. And, historically we were right, like, 55, 60%. I mean, I don't, that's what we're targeting. Let's put it that way, instead of like a claim of, how we perform or anything like that. So we do a lot of evaluation, and what sectors do we invest effectively in, and which analysts consistently have these characteristics that we're striving for in terms of the overall portfolio. Uh, so so that's what I mean by back testing and using data. Theories are all nice, but unless you're quantifying things. I mean, I think that was one of the things I learned from one of the guys I worked with a million years ago was, yeah, you're telling me that this product is going to be great for this company, but you're not quantifying it, right? So it's not useful unless you put a number on it, and then we can ultimately tie it into a target price. So everything else, I mean, that we try to think about that, from a standpoint of probability in everything we do.
And you mentioned that you back tested and you try to figure out what what signals that you thought were more signal relative than, or what metrics were more signal rather than noise. I'm curious how that filters into valuation. Like, how do you think about valuation if low to PE and static multiples are not what you're doing? What is the process of valuing these companies in a way that's, kind of, at least corresponds to the data that you found?
Yeah, yeah. I think that I had a really unusual background for most people involved in the investment business. So I am decidedly anti-bucket. I started my career at a value firm, focused on small cap, mid cap value stocks, and preservation of capital. Uh, neglect, neglect and change, and really focused on that catalyst. And then the next place I went to was completely different. It was a growth and momentum firm. And I saw how people could make money with stocks that traded at 50 PEs. So it was completely anti everything that you'd been trained to learn or believe. And as a result, like if you, we've had some clients do analysis of our portfolio, and really there's no, the way we define value doesn't correspond to the normal buckets of value. And I think part of that is because we're not reliant on static multiples. We're more focused on DCF analysis. And ultimately, a static multiple in year one or year two is only, in the context of a DCF, is a very tiny portion of the value of that company. So you see mistakes that the market makes, in times of crisis, like in 2008, all of a sudden S&P earnings evaporate for year one and year two. But in the context of an overall DCF, when the market is at trading at 666, it's like an all-in type moment from that perspective. Because so I find the same thing happens with individual stocks, and I've seen too many melting ice cubes that trade at 3 times EBITDA, when the numbers really are, it's more like it's trading at 60 times EBITDA, and they're going to violate their covenants. So I think that traditional static multiples don't work. So anybody who says like, oh, well, our portfolio is trading at 12 times PE, well, congratulations. I don't really necessarily think that, I think the thing that's more powerful to create stock price changes, it's really changes in expectations. And it used to be the sell side used to set that with earnings estimates, and now it's more something that's being conducted on the buy side, just in terms of positioning what the expectations for earnings are. So, um, to whatever extent, you can identify an event that will change the long-term DCF of a company, that to me is more important as a catalyst. And then to the extent that you can underwrite the position and have an asymmetric risk reward where your worst case scenario doesn't result in much of a capital loss. Whereas if you're just looking for something trading at 6 times PE, well, that company could go out of business, or it might be heavily capital intensive and might generate no free cash flow. So it's overvalued to start with. So I think having, being different is really important. And if you have sort of a conventional way of looking at things, you're gonna generate conventional returns. So by design, I think we're doing a lot of things that are quite different from what other people do.
With all that as background, I think it'd be helpful to understand the profile of the investments you make. Let's start on the long side.
Mhm.
So given all of that you just said, and with the valuation and trying to be different, what what makes for a kind of a quintessential Kettle Hill long position?
Yeah, I think, and that was something that we also back tested. So we went back and looked at what were the common factors of our best performing stocks of all time, and they typically looked like fallen angels, right? So at one point these stocks were beloved, and then you had like a technical breakdown, and the stock crashed, and eventually there was probably like a year or two of basing where the stock built a long term base, and then there's so it's reflective of a situation where uh, the stock is just left for dead. You pissed off so many people that own the stock at 70 that when the stock is at 10, they can't even conceive of picking up the phone to call that company. And then it's found this base. It's found this base level from which it's not going any lower, no matter how shitty the company is. So so that's sort of reflective of a situation where maybe there's low downside, but then okay, yeah, maybe it's horrible forever and it's pancakes. So we're trying to identify a change or a catalyst. Now, sometimes we come across that change first, where we identify something going on with the company, whether it's new management team coming in. It could be a new product, something exciting. And typically for smaller companies, those catalysts tend to be more significant. Or it could be insider buying. That's something we pay a lot of attention to. Is like if insiders all of a sudden start buying stock in something that looks like that, they probably identified a change internally that has not yet become apparent to the market. Or sometimes we'll find it technically. So let's say we're late to those two things, identifying the change before the move. All of a sudden you see a stock like that go from 10 to 12 on volume, a technical breakout. So there are technical screens that we do to try to identify these stocks, which means that whoever was willing to sell it at 11 no longer wants to sell at 11. And people, whoever would only buy it at, 10 or 11, all of a sudden thinks they can buy it at 12. Something has changed versus that prior pattern. So that's the perfect Kettle Hill stock that we're looking for. But broadly, we're looking for change. We're looking for situations where the numbers are going to be a lot different from the street, whatever they think, right? So it doesn't have to look like that specifically, but we're trying to identify positive change and durable change, not the sort of thing like, okay, there's a hurricane, so they're going to sell a lot of cars for 2 quarters. Like, who cares? I don't care about that. I care about something structurally happening under the hood of the company that we can understand, where there are clues that 12 to 18 months from now will all become, we become apparent to the street how the company has changed and numbers will have to go up. And it's kind of like, if you're going to ask about the short side, it's kind of like you know, flip the chart over. And a lot of times our best shorts are companies that we own long, and we discover something that all of a sudden invalidates the investment thesis. And if we've done that before other people who hold the stock for the same reason that maybe we did, if we could do that before they figure it out, then we'll sell the stock and turn around and short it. Or so a lot of times, or if we're short something and something, we cover it for fundamental reasons, right? I always say to our analysts, if you're selling the stock for fundamentals, we should be short it. Or if we're you know buying the stock, if we're covering the stock because of fundamentals, we should be long. And then, but there are other things that we look for, just in terms of creative uses of accounting, and although I think that they may be less relevant than they were, back when I first started my investing career. If we look for technicals, right? So if you come up with a situation where the stock's going up, 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 and then all of a sudden it breaks down on a little bit of volume, that means the people that have owned it for the whole ride, some of those people might have recognized that something's changed and it's ready to go down. So insider selling, if it's predictive, right? So we're looking for predictive insider selling, not just blanket insider selling that happens, continually. So um, or a catalyst, right? And a lot of times we'll be talking to companies and we'll hear about something that might point us in the direction on either way.
Thank you for sharing that. I'd love to talk a little bit about portfolio construction now. You've talked about the long book and the short book. Let's start with the long books. Long book in the long only strategy. It looks like you have about 30 to 40 stocks. How do you how do you think about concentration on the long side? How did you settle in on those numbers?
Yeah, part of it was statistical in nature. So if you just run the math on flipping a coin 10 times versus flipping a coin 20 times or 30 times, just in terms of avoiding the risk of ruin, the odds of it being tails 70% of the time or more go down quite a bit. And there's also some studies I'd seen to that effect on sort of portfolio diversification. So, um, being that this is the business that we're in, and sometimes, your results are judged on a very short term basis. That's how we arrived at, kind of like 30 being a decent number for a strategy that you want to run, and you also want, so if you isolate on just 10 bets, I mean, there's a reasonable chance that you're going to have a pretty bad year. Like 1 out of 5 years or something like that, might not be exactly what you want. And then, but I guess the static number of positions that we hold isn't necessarily representative of the number of bets that we're making in any given year. And in any given security, there may be layers of different bets that we're making with different durations. But that's how we came up with 30 to 40. I mean, if you're just running your own money, maybe 10 to 20 is the more perfect number. But in terms of running a business at the same time as running a portfolio, those are considered, especially as a small firm, these are things you have to think about.
And you essentially have 2 long books. You have the long only strategy, and then you have the long book within the long short strategy. I'm just curious about the overlap. Are those the exact same securities, or is there some differences in the long book between the long only and the long short strategy?
Yeah, generally it's like pretty formulaic. It's just like a straight formula that applies. So I don't really have to think about it. If I had to think about the volatility of that on a daily basis on anything other than a relative basis, I think I might completely freak out and lose my mind. So it's sort of designed to take, my natural conservative decision making, that I employ for our core product and just formulaically represented in the longs. There may be times when, just to, if I'm selling, our core longs, because I'm concerned about the overall market environment or something like that, there may be more defensive stocks that because you really have only the option of a certain amount of cash that we're allowed to hold. So there may be situations where we might, defensively, put money to work. Or there may be situations where you can't readjust the book, and then you have to use ETS to balance it off somehow. But for the most part, it's a direct representative of our core, long stock picking in the hedge fund.
And you seem like a very cautious and also meticulous investor. So my guess is you have limits and downside protection built into the strategy. How does so within all of that, where does position sizing fit? I mean, do you have max position sizes? Is there an out? Do you try to keep it kind of evenly weighted? Like what does position sizing look like in the long only book and the portion of the short book?
Yeah, yeah. So we've got a max individual position size of 6% in the core book. And, maybe that translates into, like a 7.5 percent position in the long only. So, part of that is avoiding the risk of ruin, right? And if a position size is going to be that big, we better have the liquidity to be able to exit it, within a few days if we really chop down the position size, so that's how we think about things. I mean, it's really just avoiding the risk of ruin that one bet might um, kill you. We've got, industry concentration limits, that range from 20 to 30%, depending on the vehicle. And, again, one bet, on one sector shouldn't kill you. And then, overall, in terms of the net exposure of the book, we've run our core hedge fund, on average, like 25%, net exposure, but we have flexibility to go, you know, minus 25 to plus 75. In practice, we don't utilize it that often, but there are times, when it is certainly appropriate, and we've done this, successfully. Well, we think successfully in the past, to be able to flex our exposure up and down on a dynamic trading basis, and thereby add alpha. But yeah, I think part of that ties in with a risk management philosophy. So A lot of value investors, they get into this, they get very stubborn, right? And I'm just not that stubborn of a guy. I recognize my own fallibility. I recognize that sometimes the market is way smarter than you. So we've got portfolio stop losses. So in the core hedge fund, if we start to lose, around 5%, it's an immediate reduction of both net and gross. And then on an individual position, there's a 20% immediate non-negotiable, cut the position in half, because I've seen it too many times. And people with mega conviction and mega ego, where that position and that thesis, somehow becomes their feeling of self-worth. And my feeling of self-worth is be able to evaluate things rationally and reasonably, and it's not tied to any one position. So if we're down that much, and we're generally try to be pretty careful about entry point, we try to be careful about risk reward. That's another thing that keeps those losses, which are inevitable, from being too large. And the way we achieve like a 2-to-1 upside downside ratio on our positions.
So I know you don't want to talk about individual performance numbers, but I'm curious, after running the hedge fund for so long, what was the impetus for starting the long only strategy in 2019? What were you trying to give potential investors exposure to?
Yeah, well, it wasn't really our impetus, I have to admit. There was a very creative and thoughtful, institutional investor who, was combing through our 13F filings and liked, they did they screened all the public managers, and they really liked what they saw in our 13Fs. And I think the thing, it's my understanding that they liked the fact that, in between holding periods, we added value, versus what sort of like buy and hold would be. So I guess that was what they thought was good about us, and that also that we didn't have that value or growth bias consistently. Like, we tended to buy value when value was cheap, and we tended to buy growth when growth was cheap. So and then just like sort of the duration of the performance, and so on and so forth. So what they were trying to do was, so the core hedge fund is structured very conservatively, right? So our goal is to generate equity-like returns with a lot lower volatility, like 25% net. So we don't run sort of like a conventional hedge fund even runs. A conventional hedge fund is way more grossed up than we are. So we just don't take a lot of risk. And part of that is, I want to be in a position of strength when others are weak. So when the world is coming unglued, when the S&P is at 666 in 2008, when COVID is going crazy in 2022, everybody's worried about interest rates. We can step in, and we can make the bet that other people can't make at that time. That's the philosophy. But these people they looked at our the performance of our longs and said, "Hey, this would be a good product just on its own, and just fully grossed up. And we're big boys. We can handle the volatility, even if you can't because you're nervous or something like that." So I think that, so we've been running that for them over 5 years. And I think it's something that, so it was very lucky that we had an investor with that kind of vision that was able to sort of parse through things. And so we're really grateful, to have be able to diversify the number of products that we have. And we're looking forward to, you know coming up with other ways, to have people consume our alpha, what we're doing.
Let's move to the short book. We haven't talked as much about that. I want to talk first about the number of positions. Currently has I think 25 to 40 positions. I know a lot of short managers who have more like 100 positions, a bunch of tiny shorts. That seems like it would coincide with your small bets philosophy, but you run more concentrated than that. Can you talk about why? And then obviously the risk management aspect that's required for being a little more concentrated on the short side?
Yeah, yeah. I think I don't think I could come up with 100 good shorts. I think and the shorts that we're putting on, they've always got catalysts in mind generally. I mean, there may be some that we're doing as a form of a hedge. So let's say, we're long a bank and we hate banks for whatever reason. We might, employ a basket approach, and some of those might be smaller type positions that might approximate, the exposure of the long that we're trying to isolate for company specific reasons. But I think the risk management discipline really helps. Being 20% stop loss. So let's say if we got a 1% short on, I mean, what's the most we're going to lose? 20 basis points. And as long as you're not stubborn, and you actually adhere to your risk management guidelines, you can reduce the overall risk. Because I mean, there are going to be situations where you get a short bought out. Sometimes the possibility that they're going to run into bad numbers in the future, well, they're very aware of that. So then it's like an incentive to sell the company, right? I think the one thing that just like we kind of avoid the micro caps on the long side, we also avoid the micro caps on the short side as well. But I've had situations where, if we're going to short a meme stock, I mean, we'll start with like 1 basis point.
Hmm.
So if it doubles, it goes to two. And maybe I'm only trying to make 1 or 2 basis points on the overall position, but it's just so obvious that the thing is overvalued and just in control of by the Reddit boards, but I'm not going to take the risk that any one bet I make puts us out of business. So there is a range of position sizes that we'll use. It's not just like take our short exposure and divide by 30 and, that's what every position size is going to be. There may be some positions that are a hell of a lot smaller just because of the perceived risk, whether it's, and we also pay a lot of attention to short interest ratio, right? And crowding, and that sort of thing. So, and generally you only really want to do those on squeezes, because if everybody's there for the same reason and they come out and print bad numbers, the stock still might go up 15%, just on, sell the, cover the news or whatever. So, yeah, that's part of just being experienced and, seeing all sorts of different markets, and see all sorts of different stocks go absolutely berserk. I mean, we're trying to hedge the portfolio and try to generate absolute, return at the same time, as we're hedging the portfolio with our shorts. So going out of business because of one short is not my bag.
And I think it's been, aside from a blip in 2022 and then a few months during 2020, you have to go back to 2009 and 8 where, running a short book has been, something
Yeah.
that's been profitable, and there have been opportunities to provide a lot of alpha on the short side. I'm just curious about what it's like to have run a short book in a period where especially the S&P has been compounding at really high rates, and curious also if you've had to evolve your short strategy as a result of that challenging period.
Yeah, I've always been more trading oriented on the short side, so really, kind of aware of working with, entry points and taking profit, pretty quickly, on downdrafts and not sticking around. Like, this is really not like running a buy and hold short strategy isn't a great idea. So I think that's how we've always done it to a certain degree, and hopefully avoid getting run over too much by one way markets.
And, what I think Jim Chanos has called this, like, the golden age of fraud or something like that. And I don't know if that's true or not, but I'm curious about, like, there are some I think we see some strange things happening in markets, whether it's with things like Bitcoin or whatever, anything having to do with AI. You were, I think, probably investing in the late '90s, so you saw some of what happened then. Just curious how you characterize the short side opportunity these days.
Yeah, I think when my overall macro view is generally positive. Like, I think in if inflation is going generally in the right direction, despite everybody being so worried right now, I think that rates generally should come down. And if Powell doesn't do it, Trump will fire him and put somebody else in who will. You're entering a period of deregulation. So overall, uh, you know, when it's like that, I try to, I don't really think that it's an incredible time to be shorting stocks, just based on my experience. Now, you can make a case based on valuation but I don't use valuation as a reason to go long a stock, and I don't use it as a reason to go short a stock. So um, I wouldn't say that I see it as being, particularly that amazing of an environment on the short side, because I feel like consumer and business activity have been restrained by so much uncertainty, so much policy uncertainty leading up to this year, and a extended period of higher than 0% interest rates. So I think if that is about to change, it's not a situation where I want to be massively short everything in the world. So I think that's how I'm thinking about things generally.
And the other thing that's been hard, in the as the markets continue to go up and the S&P's done so well, is to be a firm that focuses on capital preservation and downside protection. That style of investing has not been as in favor because the markets have been going up. How have you thought about that? How have you evolved, if at all, in the face of that headwind?
Yeah, first of all, I think capital preservation is always cool. I don't think that it ever goes out of fashion. I think that it depends on really your point in time of measurement. I mean, a firm that is more capital preservation oriented will always look pretty shitty when the market is at a super peak, right? And then all it takes is just, like a year or two of something different to make that look. But we're kind of like the slow and steady wins the race. At least in our core product, that's where we're aiming to be. So if people are satisfied with the rate of return that we're providing without taking a lot of risk, like, I don't really get too fussed, and I don't really see a need to change it. For people that want more juice, now we've got a long only, and maybe we've got other things that we can do. So then you know, that is competitive in those types of straight up markets. But there are always things that we're changing. We're always going back and evaluating what we were doing, how we could do it better. And especially in this type of an environment where it's so driven by passives, and it's so driven by Mag 7, and even like the S&P 500. I mean, if you break it down, with the Mag 7 concentration, the equal weighted, the S&P 493, the performance is roughly what the small cap performance is, right? And the S&P 493. So um, that to me, and then you've got the pods, where everybody is so short-term focused, and they're trying to take like a 1% return and lever it into like a 10% return. And they're great at doing it, right? Don't get me wrong, but it's just a different set of incentives and motivations. And you've got factors, and you've got quants, and you've got all these other things that are conspiring. To me, the pendulum swung too far. And to me, that creates an opportunity where, you know, I, I said I used to be a sector focused analyst, right? So I would see stocks move with specific reasons tied to specific events, or maybe they spoke at a conference, and they still do that to a certain degree. But a lot of times you'll see nonsensical moves based on factor movements, or based on you know, momentum stocks, being really in favor versus non-momentum stocks, or all these other stupid reasons that are influencing, and whatever macro data that the market wants to respond to, which will change. It's not always, it doesn't always have the same effect in different periods of time. So if you really know your companies, and that's what we do. I mean, part of that, paranoia is a feature, not a bug. I mean, we really understand the companies. We go meet with our companies. We speak with, the entire supply chain, and we're tracking the fundamentals on a weekly basis. So we know generally like what we think is going on with the direction of the business. I mean, obviously we'll get it wrong, 45% of the time. But so if you know that, and then you're having these nonsensical moves, like volatility is our friend. I mean, we love higher volatility type environments, and even if the overall market might seem placid, some of the underlying moves that you get between factors, I mean, there are tons of trading opportunities. And I look at the opportunity set just in terms of, where a company is trading versus its private market valuation. I see so many situations right now, through small, I mean, we started in small caps. I see those opportunities in mid caps because they're just generally neglected. You just see so much institutional money flow going to other things that the pricing mechanism is fundamentally broken. And isn't that what active management is supposed to achieve, right? So, um, I think, we've been investing in a headwind for 10 years, right? But, I think we, I don't want to speak for, what our results are, right? I can't really do that in the context of this a podcast, but, you know, I look at it as opportunity. And I think that, that, you know, I mean, I tend to be a pretty optimistic guy. I'm like an optimistic pessimist, so
Mm.
the guys look at it, right? But that's genuinely how I see it.
And you mentioned the desire to know your companies really well, I think on the both on the long and the short side. And you use an interesting phrase in your materials, which is non-consensus catalysts. Just curious what that means and how that plays out in kind of practice.
Right, right. Yeah. So when I first got started, in considering a career in investing, I wasn't necessarily just interested in stocks. I was also interested in, commodities and just trading anything. I mean, it seemed to be fascinating to me to get paid to play a game, but I would do all this research, and I would read tons of books, and just that concept of Michael Steinhardt and variant perception, right? And having a non-consensus catalyst, right? Which I feel like it's kind of easier than it's been with my time horizon, right? So we're looking 12 to 18 months in the future, and just the way that, like, even the sell side research is being catered to short-term pod thinking. A guy who works at one of those firms is telling me it's like it's not really investing; it's like a video game almost.
Mm.
Like, how will this company A perform relative to company B in the next 6 months? Because I don't know if I'm going to be here in 6 months if I don't perform, right? So, um, the types of things I'm looking at. I mean, a lot of these catalysts are not consensus just by virtue of the time frame. I can actually think about something, how it might be different in a year from now. And that's how I always thought since I started the firm. So, um, like let's say, let's say s- semis that are tied into auto industrial, right? It's been, in COVID, there was this massive um, boom because there just weren't, there's a supply shortage, and everybody was like double, triple ordering, right? And so in the heart of that supply shortage, everybody's long these stocks, and I said, "What are you doing? You've seen the inventory cycle before. Why are you long all these stocks? Well, because we're calling it the CFO, or like talking to distribution, and lead times are really low, right? And so that's not when you buy these stocks, right? You buy them when lead times are I mean, so yes, you lead times. No, it's lead times are extended, right? So you buy 'em when lead times are, you can get them anytime you want them, and generally demand is pretty bad, and they're under shipping underlying demand of the end market. That's kind of when you want to buy them. Now there are different things going on right now, just in terms of cross currents, just in terms of emerging competition in China, and ultimately, to whatever extent people might expose to EVs, versus you know ICE. But so but just if you poll the consensus of what you talk to sell side analysts, you talk to people on the buy side, like everybody generally is like thinking the same exact thing. So I want to try to think differently from everyone else and try to uncover a catalyst, so where there's lead indicators that 12 months from now, that'll be what everybody's talking about. So I think that's still an incredibly valid way to invest.
You talked about being wrong a lot and expecting to be wrong and hoping to be right, 55, 60% of the time. That means you've made a lot of mistakes, as we all have in this industry.
Yeah,
Um,
yeah.
I guess I'm curious, not talking about a specific mistake, but I'm maybe the types of mistakes that you've made in the past and you are now very, very keen to try to avoid.
Yeah, yeah. I mean, the types of mistakes. So I think that there was definitely a lot of learning that happened in 2008, just in terms of liquidity, right? So it doesn't matter if you're long a stock that is trading at cash in a liquidity crisis. The worst performing stocks were the ones that year were the ones with the least liquidity and the smallest market caps, right? So just that taught me a lesson about valuable lesson about liquidity and just the ability to exit, no matter how right you think you are, there is a scenario out there that, can destroy you. I thought we did okay in that time frame. I'll let other people be the judge of that, but felt like we could get better, and I feel like we did get better, as a result of that change. We've made errors in the past where, we've been, we have a stock that's sort of tied into government policy, right? And that inherently is unpredictable and can change overnight before you're going to be aware of that change, no matter how many people you're talking to and how many people you're researching, right? So just you still be long that, but just size the opportunity, correctly, and don't devote an overwhelming amount of research to it, right? So I felt like there were situations in the past where we've devoted too much research to one theme or concept, but you have to have a diversity of that because just in the light of the fact that, you're hoping to be right 60% of the time, wrong 40% of the time, you just have to have a diversity of bets. When we were talking about 30 to 40 stocks on the long side, like, yeah, you can't make it be all about one theme in your book because there's a chance you're going to be wrong. And then, other than that, I think about the mistakes that I've made just from a human capital perspective.
Hmm.
Um, one of the things that makes us really great is the culture of the firm, right? So when I started this company, I worked at much larger firms, and it was like a creative act, starting a firm from scratch. Like, how would you design it to be able to outperform? And part of that is also creating culture. Is so important. So I feel times when we haven't been as culture focused, or I haven't been as focused in mentoring people, because I kind of assumed that everybody would just be like me, right? And just be total self-starter and just, learn from the elders in terms of the good things, but also the bad things that we're doing, and just constantly, self-educating and developing, own views and strategy. I realized that it needed to be a little bit more involved and hands-on, and I had to commit some of my time to help grow the people at the firm. So I feel our team is incredible right now. And that was a mistake that I made that I felt like we course corrected. And then I also think I've made multiple business mistakes over time, right? So I realized that, you know, I'm a product person and not necessarily like a CEO. So, we brought in Afroz Kadir to be our CEO, and when we did that, I mean, just all the business decisions got a lot better, because I sort of recognize that weakness in myself as not being like the most credible business person, and just being more like creative, investing person. And then, and I think now, like, finally at the age of 52, I feel like I've learned all these things, and how, maybe my career can start, and that keeps me young. It keeps me excited about things because, like, I guess, Buffett and Munger, right? They didn't really hit their stride until their 50s. So maybe it took me, this long, since I first started in 1996. I mean, maybe it took me this long to sort of figure out. So I think we're doing interesting things in terms of packaging our alpha. It's kind of like, Nike would be a pretty crummy stock if they only had one sneaker, right? So we were just kind of like, here's our sneaker, and you better like it, or here's our Henry Ford. You can have any color you want as long as it's black, right? So I think if we could take what we do and put it in a package that would appeal to more investors, like just from a business perspective, while keeping in mind that we don't want to, we want to constrain the amount of overall AUM. So, and we just over 21 years, I mean, just so many mistakes, and even week to week, I mean, just getting humbled over and over
Mhm.
again. But then getting up and trying to learn from it, right? And I think that one of the great things that we've got in our culture is this positive mindset, right? So it's like a sports psychology type thing where, I don't want people to be scared to shoot. I want to be people scared of my opinion. And I want to have everybody be empowered and be able to say what they think. And, we're seeking the truth here. And yeah, you said it was a long last week, but you found something out different. So don't be scared to tell me about it and tell me to sell the position. Like I don't really care. I just realized it's all best efforts right here. So anyway, that's how you just kind of perpetually improve and try to learn from your mistakes and move on.
And if you're thinking about what Kettle Hill looks like when you're 60 and you're even more seasoned than you are now, what would
Uh,
success look like to you if
I don't want to think about what I'll look like when I'm 60. It's bad enough at 52. But yeah, to me, I mean, the way I define success, I mean, first it's like, am I still married to the woman I love? Are are my kids happy and successful? Have I been able to launch them properly? In terms of Kettle Hill, have we maintained the culture? Have we achieved our business objectives and then used that to make really smart investments in human capital, that, some of those investments can be negative, subtractive, right? If you don't get the right person, right? So it's really just really focusing in on our team culture, aligned incentives. As long as we do that and just keep to our core principles, I think we're going to do just fine. But I would like to grow the business. I would like to diversify the types of products that we offer, and at the same time as, just my goal, when I'm 60, you just look back and say, hey, generated a ton of alpha and, provided flexibility and options to our clients because, that's what we're here for.
well, Andy, this has been an incredible summary of philosophy, process, the tactical nature of your strategy. We're going to close with a question we ask all of our investment manager guests. What is the most underappreciated aspect of the investment opportunity in front of Kettle Hill today?
Uh yeah, I mean, I think it's that point about small and mid cap stocks and the Mag 7 and so on and so forth. Just people looking at the historical performance, just being like, okay, well, why don't I just go into passives and blah blah blah. I think that you know w- we're what we're doing, we're seeing more opportunity in front of us just based on the dislocations. Like we invest in dislocations, and this environment is causing a ton of dislocations that we can invest in. So that's what gets me excited about. But I also think that under the hood, I mean, it's really understanding the people and the team here. I want people to be partners, not employees, right? So just the way that we create the incentive structure, we really share the wealth with everybody at the firm. So they're incentivized to act like a partner, and it's like one of those under the hood things that we're looking for in companies, that we're investing in. I don't know that it's readily visible to people how energized our team is and how great our culture is.
That's a wonderful place to stop. Thank you for sharing all of that. I know it's been, the term hedge fund is not quite as sexy as it was back in 2006 and 7 when anyone could raise a fund, but you guys have made it through. You survived. I think you've done a nice job protecting capital for your investors. So I'm excited, especially since you hired a good friend of mine to work with you. I'm excited to see where this firm is in 8 years. Thanks for being
Yeah,
our
me
compounders.
too. Me too. Thank you.